So, what can we all learn from the Spirit Airlines bankruptcy and apply it to the business of private lending? We're going to talk it through right now.
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey, everyone. Thanks for checking out the show. We appreciate it. We're going to dive into the Spirit Airlines topic in just a minute. Also, want to do a quick recap. We just got back from our mastermind meeting in Charlotte, which, by the way, if you've been considering coming to one of our events, our next one is here in Maryland in June, second week of June, I believe. To learn more, go check it out at hardmoneymastermind.com. Click on live events and schedule a time to talk to our team. All right. Yeah, we had a good one. It was a good week. It's a good time in Charlotte. A lot of the same people have been in the mastermind for years now. You know, that we're going on 7, 8 meetings, something like that with a lot of people. Everyone's stuck around. We've been able to see all of their growth and maturity, right? Like a number of these lenders, when they hooked up with us, were earlier in the game, right? They had been in the game like 1, 2, maybe 3 years, maybe doing it as a side hustle, not really going all into it yet, whereas now they are. And I think it's interesting to see how people grow and how they mature in terms of you have to learn from experience. You know, like you can hear from us, you can hear from the podcast, you can hear from other members in the group, but things like loan defaults, turnover in terms of employees, right? Market cycles, competition, like there's a lot of stuff that you really have to live it.
Yeah, it's hard to see it on paper. It's hard to hear somebody doing it. I know if I was in people's shoes, I'd be stubborn as well. I'd be like, yeah, I think I got it all figured out. I'm just gonna do it my way, type of situation until you and that's what we don't want to happen. We were talking to somebody coming to the mastermind in June. Get a little intro call with them earlier this week, and I felt like I gave them really, really good advice. And I don't know if they took it or not. And it hasn't really hit them yet because maybe they're too early on. But this particular topic, I was like, do this, I promise you. Like, just do this. This one thing. And like, it's going to help. It's going to help your business grow. It's going to help capital raising. But I get it. And, the other thing about the mastermind group is everyone gets to see our growth as well. Now, technically, our portfolio size has stayed around $50 million for a long time. So they haven't seen that growth, but there's like you just used the word maturity. We've matured. We've become better at what we do, and we consistently become better. And just because our portfolio size isn't growing, that doesn't mean that our bottom line revenue is not growing. And that's the name of the game. That's the goal, to try to make the most amount of money that you can, without potentially taking on any more risk and things like that. So, and we have seen year over year more bottom line revenue growth without taking on more exposure and growing our loan portfolio size. And we would grow our loan portfolio size if we felt we could do it in a safe, responsible manner, um, no doubt. But there's other things of growth. Um, let's talk one more thing real quick about the a big takeaway, because I think we'll probably do a show at some point, an episode recap. But 6 months ago, the word or letters AI did not come up at all. And if it did, it was like, "Hey, check out this cool meme or image or video that I created using AI." That was a hot freaking topic. That was a hot topic, and everybody in the room is using it to one capacity or next.
Yeah, last meeting in November, it came up for exactly what you said, creating funny videos, right? Like little spoof videos, look what we did kind of thing. And then also outbound AI calling. And those are the only 2 topics.
Yeah.
And this
Nobody
time
was
it
u
was
nobody
always
was
them.
using, they were talking about, could it work?
Right, or they're about to start testing it and
Yeah.
stuff like that. In this time, there was plenty of time spent on AI, the stuff that we're doing with the inbound calls, some CRM related stuff, content creation. I mean, even people building software for various aspects of their business, right? Because it can be done so easily. So there's significant amount of time spent on AI this time. And I bet there will be in June as well. Um,
L-
yeah, some
Let's
of the
go ahead.
no, I was just thinking of a couple quick examples of the the stuff that you go through over time that you end up learning probably on your own, even though you've heard it. Just a couple more examples on that we'll dive into the Spirit Airlines lessons. But one related to Spirit Airlines is leverage. Like everything is fine. Like before you have a default, you can lend it whatever LTVs you want because it just hasn't happened yet. And you kind of get brainwashed into thinking that this is fine. All these loans perform. Like even if they go a little sideways, I'm going to get out of it until you do catch that real default. And catching a default is not a huge deal. It's going to happen. We're in the business of lending. There's going to be a percentage of your portfolio that's in default and a much lower percentage that actually gets through a foreclosure auction sale. And the game is how do you exit? And now that we've seen some people in the room years into the business have these actual foreclosure situations, they might be looking back and adjusting. Not might be, they definitely are looking back, doing a little postmortem on a deal that went bad and say, what would I do different? And a lot of the answer is going to be my loan amount was too high. I would have made it out clean if I were 10% less or whatever the number is on the LTV. Um,
Yeah, that's the case of every default that people have had. Yeah, it
mhm,
was
every time.
if I had them bring a little bit more money and my LTV was a little bit lower, I would have been okay. Because as important as the characteristics of the borrower are, because that's second important as much as collateral, a lot of this wasn't character oriented. A lot of this is collateral oriented.
Yeah.
And
Yeah. Because I mean,
I don't know,
even
go
good
ahead.
borrowers can go sideways sometimes. It's just part of speculating in real estate.
All right, let's shift over to Spirit Airlines because I'm going to give credit where it's due. We got this idea from Bryce Matheson, lendersoftware.com, because he was in the group, and you know, there's not many podcasts on private money and private lending and hard money lending. Bryce has one through Lender. Kevin Kim has his, and that's it. But I'm always kind of scraping to see if there's any kind of industry stuff. Uh, that I want to listen to. And I was, looking at some podcasts for a plane ride home, and I noticed Bryce did one on Spirit Airlines. And I actually haven't listened to it yet. I'm sorry, Bryce. I will listen to it, but I have not. So I don't even know what he talks about. But soon as I saw Spirit Airlines, I had an aha moment, and I'm guessing this was the topic that he had, which is why Spirit Airlines went out of business and how that's related to hard money lending. And it hit me immediately. And I was like, yeah, they have the cheapest, they had the cheapest flights. They were the commodity, and they had the cheapest flights, and they had, the lowest barrier to entry to book a flight with them. And you go to Cancun for 29 bucks or 50 bucks or 99 bucks or whatever the case is. It was super, super inexpensive. So it attracted that type of clientele. And after you're known as a cut rate airline, like it's hard to change. So, quick reality check to hard money lenders. It's the same thing. If you're not charging enough and your LTVs are too high, and you're, have a low barrier to entry to work with you, because it's like, sure, I'll give you 100% financing. Sure, that guy's offering you 13 and 3. That guy's offering you 12 and 2. I'll give you 12 and 1, or I'll give you 13 and 2. Like, there's your brand. You just created the Spirit Airlines of hard money lending, and you didn't even know it. That's your new business model. And I can assure you that's not a business model that's sustainable or a business model that you're going to want, because you start doing low terms, high LTVs to borrowers. That is their new expectation. That is what they're going to expect. And they're going to leave you if you don't give you those terms. And you're going to be like, okay, or they're going to say they're going to leave you if you don't give them those terms. And now all of a sudden you're stuck and you're doing deals and you're not making any money. Just like Spirit Airlines was flying planes and had a business that didn't make any money because they didn't sell high enough ticket sales. The same reason you're doing loans at cheap terms, because you feel like that's the only way you can do business. But what does it matter if you're doing business if you're not making any money anyways?
Earlier today I was watching a webinar, a Zoom webinar from AAPL on the State of the Union that I guess they do a few times a year. and I'm sure I've checked it out in the past, but I decided to get on it today to see what they were talking about, and it was mainly just industry stats, right? Um, Average interest rate across the different types of loan products, average, um, loan amounts, the states where lending volume was highest, and a lot of this is skewed by California, to be honest, because it's such a huge geographic area and a large population, and so many deals in the industry are happening there specifically. And so it definitely skews the whole thing. But and then besides behind that is I think Texas and then Florida, or maybe Florida first, then Texas. But that part of the industry, the institutional world, they do a lot of the Spirit Airlines type stuff. Like they want to do as much loan volume as they can, as many loans as they can possibly do, even if they have to cut price, points, and rate. A lot of the rates that they're doing are in the 9s and in the 10s for, rehab loans, and high volume, high loan amounts because, that's Southern California, it's just the way it is, and same with, Miami-Dade County. Um, but there's a lot of Spirit Airlines stuff because they have to survive on volume because their profit margins aren't there, right? Like, they have to do, just it varies for these different companies, but, like, if you had to hit 50,000,000 this month and that was your main metric, what would you do? You would I mean, unfortunately, I think that sometimes they're not putting enough emphasis on the bottom line. They would rather just put out more loans, and they'll cut price if they have to. They'll over leverage for sure. That's how they compete, and also they go in too heavy with individual borrowers. They basically do all the stuff we preach not to do when you actually control your capital and you're responsible for it and you want to use it as an investment vehicle. It changes your behavior a lot. But there is a lot of so like I mean, I was watching that webinar and then I knew that we were about to shoot this podcast right after. And I couldn't help but think there's a lot of Spirit Airlines sort of characteristics being discussed in that webinar.
Yeah, no doubt. And like that sounds like that's a great idea. I mean, we know local lenders that fell into that trap. They started in the business.
Sure.
They didn't really focus too much on marketing because they're like, yeah, I don't really want to market. I got capital. Like people will come to me, blah, blah, blah. They start doing deals. It's at high leverage. It's at cheap terms. And next thing you know, that's the majority of your portfolio. And you say, well, I've got some staff members now. I'm making a decent living. I've got a lot of money deployed. And I go to one of my better borrowers and you subconsciously know it's like, you know what? I kind of want to be a little bit more conservative. You go to some of your borrowers, you try to tell them the next deal is gonna be a little bit more expensive. They're gonna need more down payment. And they're like, nah, I might go in another direction. And then all of a sudden you're like, okay, I'll just keep it the way it is because I'm too scared to lose my borrowers. And the reality is if you're in that position, like you need to take several steps backwards in order to take several steps forward before it's too late. Um, had a conversation with somebody who, didn't have many defaults in the past, and they had one of their best borrowers default, and it took down 2 or 3 projects that he had funded. They're gonna lose money on those deals, unfortunately, because they lent too high. I don't know what the terms were, but the leverage was definitely too high, and it was like, "God dang it, man." Like, I thought this would work out, and, little piece of advice is like, at some point, things come to an end. Markets come to an end, industry comes to an end, relationships come to an end, deals come to an end. And like this borrower was used to getting cheap capital and doing marginal deals. And it got to a point that he didn't sell over market value. So it was like, okay, I'm going to have to fire sale these deals. The guy wasn't malicious, he wasn't trying to steal money, but he wasn't making any money on the deal. And he walked away from the deal and the lender loses money. It didn't have to happen that way. And I think it finally comes to a point where it's like, okay, well, what's the alternative? It's like marketing. That's the alternative. Finding deals. This is a business. This is a job. This is real. This isn't like, okay, cool. I go raise some money and I put some infrastructure in place and now I'm a lender. It's like, no, you're a marketing department. And I will tell you, and we're guilty of this as well. I do believe that we spend more time and effort on marketing than most other lenders, but we are guilty of this as well. Most hard money and private lenders marketing budgets are significantly less percentage wise to their revenue than almost any other industry, right? Like if you started a restaurant or you started some sort of business, you'd have a marketing budget in place, right? So like typically like highest costs are, payroll, maybe rent or mortgage, and then, marketing expenses and things like that, depending on the industry, obviously. But like so many lenders don't want to spend money on marketing. They don't want to spend time on marketing. They don't want to spend money on marketing. I don't know what it is. Like it's all we're focused on is marketing on a regular basis. And I'm not trying to just say throw away dumb money at stuff, do up a ramp up period. But most lending operations have a budget to market. And if you don't have a
Yeah.
and like if you don't want to, if you want to use your budget to pay somebody to generate business for you, leads for you, that's okay too. But it's so important. If you don't market, as soon as you get past your lowest hanging fruit or, your sphere of influence of local real estate investors, that you're doing deals. You can deploy a few $1,000,000 like that, no problem. That's easy, right? But as you continue to grow and scale, like you need to find other means and you have to market. And, you know, I don't know. It's
Well,
so frustrating to me that people don't hyper focus on it.
here's part of the reason for that is that a lot of lenders, even people in the mastermind group, their main constraint is still capital. And they think that, oh, I can't do too much marketing because I don't have enough money to put out, even if they're already at like a, 30, $40 million portfolio. They might not have enough on the sidelines to make them comfortable enough to market. But here's why that's a little faulty. That you don't have to consider marketing to do more deals. You could use your marketing to do better deals,
That's
right?
right.
Like if you're doing 10% down fix and flip deals, if you turn on some marketing, you can put out more conservative quotes because you simply have more deals to choose from and get to a place where you can quote the way you know that you'll exit fine in the event of a default. Because like Jason was just saying, even really good borrowers default in residential real estate investing at some
No
point.
doubt.
Happens all the time. They're speculating. It's a speculative kind of business. Like and it's a hard one too. Running multiple properties, rehab jobs, this crew, that crew. Like there's a lot of things that can go sideways. So anyway, consider that for a second. If you're like, well, I don't have enough money, that's why I don't do the marketing. Do the marketing so that you have more deals to choose from, so that you can give better, safer, and maybe even more profitable loan quotes. Um, One more thing too that like backing up a little bit, talking about the meeting that I know that people have to go through this on their own because we went through this. Our business partner Ryan went through this, and it came up at the meeting is that it is very, very common in this business to be like, all right, I know that my box with our funds is doing, for example, rehab deals and bridge loans on residential investment property in this state, right? That's our box. But since I'm a private lender, I get leads for a lot of things that aren't that. Maybe they're DSCR loans. Maybe they're commercial and that's not something you do. Maybe it's ground up construction. Maybe it's in the other 48 states where you don't lend, right? And you can't help but think, why don't I broker these out? Why don't I process and close a DSCR, right? It's my customer. I did a fix and flip loan for him. Why don't I do that too? Or why don't I hook up with this institutional lending source so I can start lending in these states over here? It is very logical at first to think that. Why am I leaving money on the table? I should be doing these loans too. And here's what happens. And again, this is something that you'll probably have to go through on your own. May or may not take it from us, but it deserves to be said because the pattern repeats itself over and over. The reality is that when you try to do that stuff that is less profitable and outside of your box and significantly more work to get closed, like ask anybody. Like we were talking to some people coming for the June event about doing DSCR loans on the side, and they're like, oh, I hate it. I do them, but I absolutely hate it. I don't make enough money. It's a pain in the ass. It's messing with my reputation with my borrowers because I can't get this institutional DSCR shit to close. And look, we've been there early on in HMB's history. We saw our business partner, Ryan, go through that 2 or 3 years ago where he just had the itch. He's like, I want to close these deals. I know that we can make extra money if I do this. And it came up in the Charlotte meeting. Exact same thing. We're thinking about doing all these things, blah, 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 credit line, all the kind of stuff that are outside of the model. And the reality is it just takes your focus away from the core business where we control our risk, where we make the profit margins we want, and where we can efficiently and effectively get deals to the closing table, right? And so everybody goes through that. I'm sure there's people listening and watching right now that are like, shoot, that's exactly what I'm trying to do is I'm trying to broker out all these other deals. It's a complete pain in the ass. But hey, if you have to go through that on your own to learn, so be it. Go through it, give it a shot. Everyone does, and then come out the other side and stick to the core model of the business. That's what HMB is about. That's what our mastermind's about. And if you're thinking about coming to work with us, it would be a good time to do it here in our own backyard, in our home club where we're hosting the event in Maryland. Go check it out at hardmoneymastermind.com. Click on live events to learn more. And we hope to work with you in person. We'll see everyone here next time on the podcast.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.